Yeah.
Um, so anyways, as I was saying, like, I just love entrepreneurs. It's, I dedicate my work life to supporting entrepreneurs. And it's, as I said, it's a joy to be here and be with this group, particularly, as I said, to see a group of women. So Julia asked me, hey, how did you get into venture? So I actually have been in venture now for about 10 years. My background consists, I also did some consulting. So I worked at McKinsey for about 4 years. I also ran my own consulting business for 4 years. So I had consulting experience. And then I also had done operating and entrepreneurial things. As Julia mentioned, I had worked at eBay in Silicon Valley in the early days of eBay and really helped to accelerate the growth of that business, which was a phenomenal experience. I also had launched and built Kijiji in Canada, again, a tremendous experience, great team there. And so what I discovered, so first of all, I was contacted by Real Ventures and they said, hey, we're looking to hire a partner in Toronto. Are you interested? And my first reaction to going into venture capital, I thought, no, I'm not going into venture capital. Like, isn't that industry like completely dominated by men? And isn't it just about like these men cutting down entrepreneurs and negotiating hard and like that's not me. But what was interesting is the idea intrigued me enough that I started doing more research into it, and I started mentoring some startups. And what I discovered was actually the most successful investors are those that really take the same side as their founders and are there alongside their founders and help them build amazing businesses. And I realized that it was a combination of, what I loved about consulting was working alongside business leaders and, doing that sort of thought partnering and working across multiple companies simultaneously and sort of saying, oh, what worked over here? How can it work over here? And having that broad perspective. So I love that. But I also love technology and I love the upstart and seeing companies grow. And so I realized that actually venture capital could combine these two loves of mine. And so I got into venture capital investing 10 years ago and I absolutely love it. I sort of feel like this is sort of made for me, or at least maybe I was made for it. I don't know. But, this is what I want to do for the rest of my life.
Fantastic. Fantastic. And just before we leave this, because I mean, we need more women VCs, right? Too.
Yes.
Would you recommend any path for women that are considering becoming a VC?
So I think like anything, there's a lot of different paths.
Yeah.
I do think that one of the best paths, if not the best path, actually, I won't say the best path because there's different, everybody will find their own path. But I think that being an operator is a fantastic way to then become an investor.
Mm-hmm.
And I will say that my experience as an operator has been extremely helpful with working with founders. And I think it helps in two ways. One is having the empathy and the understanding and the credibility. So it's like almost on an emotional level.
Mm-hmm.
And then the second is just knowing sort of things that I can add value to. Like, what do you look for when you're hiring your first head of sales? What does a great marketing person look like? How do you manage all of these different things? But if I'd have to pick, I actually think that the first one is that empathy is almost more important. And, we can get into this later in terms of Staircase Ventures and how we do a whole bunch of founder development and the care that we give to our founders. And I think that a lot of that is rooted in me being a founder. And I have had exchanges with other venture capital folks who will be around the table. And I'm like, no, like you cannot talk to a founder like that. Like, do you have any idea how much stress they're under? Right? Do you have any idea how hard they're working? Right. And it's just like having been there, I think is extremely helpful.
That's great.
In order to that empathy and seeing things from their perspective.
So you led into it. So I think Staircase Ventures is really different in the principles that you're using and the value you're bringing to the founders. What coaching, wellness. Tell us a little bit more about what you're doing there and why you're doing it too.
Yeah, so I sort of mentioned that I got into venture capital about 10 years ago when I joined Real Ventures, which at the time was one of the largest, most active early stage investors in Canada. And I spent about 8 years there, and it was fantastic. I learned a lot. But I decided to leave Real Ventures and start my own firm for a couple of reasons. But one of the most important things is being at Real. Through my own investments, I led investments in over 20 companies, plus the firm as a whole. While I was there, led investments in over 100 companies. So I got to see a lot. And, probably not surprisingly, the most significant success factor for any early stage tech company is the founders, right? And you can probably relate to that. It's you, right? Every day there's challenges. This doesn't go right. You lose a customer. Hey, you got to pivot. Oh man, there's challenges every single day. And it's not about, hey, what business plan did you write? And is that business going to work? As much as who is the founder? And can that founder navigate those emotional challenges? Can they make it through? Do they have the resilience? Can they go from managing 2 people to 20 people to 200 people? Like that ultimately is the most important success factor. But what's interesting, and frankly, most investors will agree on that. But what's interesting is if you ask any VC, how do you add value post-investment? They will always talk about how they add value to the business. Right. And so they will talk about, we'll introduce you to customers, or we'll help you with your financial forecast, or we'll help you hire some engineers, which is great. And we said, hey, we're going to do all of that. But in addition, we are going to help the founders scale and perform, because that's the most important success factor. And so as a result, what do we do? So we have a 5-pillar growth platform. First one is executive coaches. And all of these things were based upon what I have seen has made a difference for founders. So executive coaches, I have seen that can be a real game changer for entrepreneurs, to have somebody who is a professional coach who works full-time coaching other startup founders and is someone they can confide in and who can give advice to them. So Staircase pays for that. Second thing is founder support groups. Again, what I have seen, and I think this is great. I think looking at the SheBoot group, and I know you guys, building the group together, is having other founders who are going through similar things or have gone through similar things, and being able to learn from them and share experiences is extremely important. So hence we pay for founder support groups. Then the third thing is a personal health coach. So we did a partnership with Cleveland Clinic Canada. And so all of our founders have access to a confidential health coach who can help our founders with anything from, hey, I'm having trouble sleeping, to I can't figure out how to get exercise into my daily routine, to I'm not eating very well, to I think I'm having anxiety or depression or anything like that. So anything mental or physical help, they are there to help the founders. And so that's number 3. The number 4 thing is a personal financial advisor. This is somebody who can help the founders themselves think about, how are you structuring things? How are you for your personal, because we care about the person, not just the company. I care about you. And then the 5th thing is a family stipend, which is a cash payment in the first year. It's like no hold, like just cash payment, and no strings or no whatever attached. It's fully discretionary how you spend that. But our belief is, our recommendation, our guidance is that, hey, really, this is for you to spend on either childcare, outer care, take your significant other out for dinner, take your best friend away for a weekend, whatever you need to do to recharge your batteries. And it's a real recognition that, hey, people are not machines. They have other people around them, and we need to help people perform their best. And so you look at that platform as a whole, and it's got sort of the first 2 elements around coaching and peer support groups, which is like, hey, how can we help the individual improve their skills? And then the latter 3 are more about, okay, yes, but how do we help them show up their best every day? How can we help them show up their best every day? By thinking about the individual in the fullest sense. And I think what's interesting to me is, and I will say this is what has been fascinating. So I had this concept, I went out, I raised funding, And a lot of the reaction from my investors, so it was twofold. People who are professional investors, they were like, okay, if that's what you want to do, okay, yeah, okay. And I had some entrepreneurs who invested in me, and they were like, Janet, this is game changing. And then when I went out and launched the fund, the response from the founders is like, this is game changing. This is amazing. I love it. And so again, you speak back to that what I talked about earlier, that emotional connection. And I think you almost have to have been a founder to understand the life of a founder and be able to relate to that.
Yeah, that's fantastic. And all really valuable. I mean, before I exited, I realized I personal tax planning was not good enough. I wasn't protecting my family well enough. So, taking the time to do that as a founder is a very important thing. Financial look at how to make sure that you can exit and bring as much money home as possible.
Absolutely.
So, Janet, thank you. And tell us a little bit more about your fund. I mean, you're written up as, you raised last year during a time when it was really difficult to raise. You put together, and I have 30 million. I may not be up to date. Is that the number we're looking at?
34, actually.
34 million. But you put it together when all of these founders know it was hard to raise last year. And you were raising a fund. Really, how did you manage to do that? It shows a huge confidence in you as an angel, or as a VC as well, too.
Well, thank you very much for that. So I would say, yes, my fundraise went very well. I started raising December 1st, 2022. Typically for a first-time fund, even though I've been in the industry for a while, this was a first fund. It can take 12 to 18 months to get to a first close. My target size was $25 million. I closed 22 million in March 23. So it's about 2 months later. It hit 27 million in June, and we got up to 34 million by the end of the summer. So it was a very strong fundraise. I definitely benefited from my track record and my experience and my reputation, having been in the industry for many years. But I think a couple of things. First of all, I'm a huge believer in life is long and the world is short. Mm-hmm. And how you treat people really matters.
Absolutely.
And I have had a few people, and frankly, I'll say men, who have either said to me or said to people I know, how did Janet raise such a big fund so successfully? Like, what was her trick? What was her trick? Because I want to do the same thing. I was talking to a friend who one Saturday we were having brunch, and he tells me, oh yes, such and such investor was basically saying the same thing to him. And it suddenly occurred to me, I was like, you know what? I didn't raise a fund in 7 months. I raised it in 30 years.
Yeah.
And he can't come along and say, oh, I'm new to the fund, I'm new to this world. Why can't I be as fast as Janet? I'm like, look I've been working on this, all my life. And so I guess I would just say that, and I don't say that to discourage anybody who's early in their career, but more to say that, hey, everything builds on one another. And anyways, I ended up writing a blog on that. But when I look at the people who invested, like 2 people who invested, angel investors, I went to business school with 30 years ago. Right. And it's, then I had institutional investors as well, or Royal Bank invested, and they said, well, we never invest in emerging managers. We never invest in first-time funds. But, Jan, we've known you for years and we want to back you. So I think, as I said, I say that not to blow my own horn, but I hope to give you confidence as you're embarking on your journey, and to say, who you are really matters, and how you treat other people, and the type of integrity you carry yourself with. And it's just so important. And I would just say, actually, it's a little tangential, but I just thought about it too. As you're embarking, because I look at everybody here on the screen, and I think, I hope that each one of you is massively successful. The odds would say that, unfortunately, some people will not be as successful. And when I was a VC-backed entrepreneur, I used to be really concerned about raising money and not being able to deliver the money back. And so I would just say, what I have learned as an investor is what matters to me more than anything is, did that founder give it their very best shot? And were they honest and authentic throughout and transparent throughout the whole process? And I had one entrepreneur that I invested in, and at one point it looked like his company was going to go under. He said he was able to pull it out. But I said to him, okay, just so you know, I said, if this goes under, I said, I don't care what you do next. I want to be the first check into your next company. Right. And it's because, and I tell that story because I hope that you, if you ever are in that situation where you're like, oh my gosh, what am I going to do? If your business is not successful, it doesn't mean that you're not successful. It's just that that idea didn't work out. And if you carry yourself with integrity and you're transparent, people understand that and they will see you for who you are and will want to take another bet on you.
And I love that word authentic. It's one of my favorite words too. Being you and not trying to be someone else. I think a lot of we get a lot of male stereotypes that we have to work around, and being ourselves, I think, is harder, but it really is worthwhile. The more you can be yourself, and to investors and to each other as well too.
Yeah, absolutely, absolutely.
So Janet, these group I know is incredibly curious about, who do you invest in? What are you looking for? What's your check size? What do you take the lead in an investment? All those types of questions.
Absolutely. So our focus is to lead seed stage rounds of Canadian-based business-to-business software companies. So just to dig in a little bit more, so primarily Canadian-based. We're going to make 12 investments from our fund. We make about 1 investment per quarter. 1 or 2 may be in the US, but I'm very bullish on Canada, and the vast majority of our investments will be in Canada. Business to business, as opposed to business to consumer. For a few different, I can go into the reasons why if people are interested, but that's what we're focused on. And then software, so not hardware. We stay away from that. I stay away from deep tech. And I would say, and by the way, when I say business to business software, it doesn't necessarily need to be SaaS. There are other monetized business models, like it could be a marketplace, it could be a transaction model, but business to business software. And so seed stage, primarily what we're looking for is a product in market with some initial product market fit, some paying customers. And then in terms of and typically what we see, so we've announced 4 investments to date. Mm-hmm. One was actually a pre-seed investment that didn't have a product in market, but I knew the founders very well, and they were repeat founders with a clear vision, and they didn't have a product in market, but they'd done a lot of work. And then the other 2, in terms of their revenues, were around 500,000 to 750,000 annual revenue. Okay. Our initial investment is anywhere between 500,000 and 2 million for a minimum of 10%. So we like to lead rounds. We have, I think, fairly standard terms, and then we take a seat on the board and get involved in the company in whatever way is productive and helpful. And so what I mean by that is, it's not a cookie. I don't think of it as cookie cutter. I look at it as, hey, you know what? Like, yeah, okay, I'll be on the board. I'll come to the board meetings. But beyond that, like, the real work happens outside the board meetings. And it really depends. Like, I will say to my founders, and nobody's taking me up on this, although I really wouldn't mind. I said, I'm on your side. And if the biggest value that I can add is come to your office on Saturday and like take out your garbage and bring you coffee and donuts, like, I'll do that. Like, that's fine. Like, I just want to be on your side. Okay. And I'm there to help. And so now in reality, one of the reasons I say that is because some founders have much more experience and other founders are less experienced. And some founders need customer connections and some people need guidance in different ways. And I'm just like, hey, whatever works best for you, whatever can help you be successful and help your team be successful. but I have got involved in strategy working sessions, in hiring people, in interviewing potential candidates, in thinking through, okay, who should you hire? What are the option plans? We have 8 advisors, all of whom have launched and built billion-dollar businesses that work with our portfolio companies. They come from a wide range of industries and functional areas of expertise, and are located from California to Toronto. And so those people get very involved as well when we need specific advice or help for the companies.
Yeah, that's fantastic. So tell me about, if you're comfortable with it, a little bit more about some of the companies you've invested in to date, just so that they can sort of see themselves in those companies.
Absolutely. So if you want more information, it's all on our website. The 4 companies that we invested in. And I also recently posted a blog post that talks about each of the 4 companies and really the rationale of why we invested in each of those 4. So I would, direct you to that. But I will just say we have invested in a wide range of companies. We invested in fintech company based in Calgary, led by an amazing woman, Alice Reimer, who some of you may or may know.
It's really amazing. Yeah.
She's amazing.
Yeah.
Second company is a company called BioSil, which is using AI for drug discovery, based in Toronto. Third company is called Renti, RHENTI, that's in the prop tech space. Fourth company is a company called Sibley, and they're using AI to help institutional asset managers make better investment decisions. So as you can see, again, you can read more information about it, but a wide range of industries.
Okay, so no fear of AI in your product,
Yeah.
Okay, great. Good to know as well too. Excellent. So I'm going to open up the floor, and feel free to, and stupid questions are allowed. So I'll start with the first stupid question, because early stage, pre-seed, seed, we throw those names around, but what's your definition? How do you wrap your mind around those terms, Janet? And again, anybody who wants to have the next question, raise your hand. Okay.
Yeah, so it's a good question, and I think the sort of definitions are always changing. One framework that might be helpful is, I think about a 3-pillar, or a 3-legged stool maybe.
Okay.
And the 3 legs are team, vision, and traction.
Mm-hmm.
And I would say you need to have and be strong in at least 2. And what I mean by that, so you look at the company BioSil that we invested in, it was very early. So the traction was relatively small, but the 2 founders were repeat founders. They'd worked together for years before. They built a company, exited it, and they had a big vision and a big in terms of how they were going to use AI in a very innovative way. And so they were able to raise a strong round. And then it depends, right? If you as a founder are not as proven, then you may have to have a little bit more traction and a little bit more differentiated product in order to have that same appeal.
Yeah.
So I don't know if that's helpful at all. But I think today what I'm seeing in seed rounds is, as I said, sort of $500,000 to $750,000 in revenue annually. There are exceptions to everything. And then sort of, $5,000 to $10,000 in monthly revenue is more pre-seed.
Mm-hmm. Okay.
But again, it depends, right? On the flip, depends what you're doing.
Yeah. It seems that it definitely moves around that line. Okay.
Yes, I think consumer businesses generally, you need to have more revenue, because a lot of consumer businesses are more based on execution, or are largely based on execution. Yes, you have to have a great product, like Hope, dog pet food, right? Great product, but I think a lot of the key will then be in the execution, and so you often have to see more metrics. Conversely, if it's a deep tech company, right, like maybe you're developing a new chip, where you may have no revenue, you might be able to raise lots of money with having no product in market,
Yeah.
Okay.
Yeah.
Hey, Al?
Great. Yeah.
It's great to see you again.
Yeah, you too. Just a quick update, as we are collaborating with Philip Fleet, so working closely together and progressing, I would say. Okay, so my question was, in your experience, do investors, especially like VCs, invest in products that have existing competitors? So for example, in our case, we are doing fleet tracking. There are existing players. There are consumer players and there are enterprise players, but there's a huge underserved small business market. And there needs to be a product design for them, which wasn't there, which we brought in different ways. But the struggle that I'm facing during my raise is, and I understand the investor's perspective, is they feel higher risk because there are other players. And in this case, what would be the next step to de-risk it for them? Would it be that I generate more traction, to your earlier point, so to give them a view of repeatable sales?
Well, I think so. I guess one way to look at it is to think, what are the risks of the business, or what could go wrong, and then how do you prove that those risks are, I don't want to say prove that those risks don't exist, because risk always exists. So how can you de-risk, I should say?
Right.
So I guess I would think off the top of my head, the two biggest risk factors are one of the existing competitors will move in to the small medium business, or that the small medium businesses will not adopt fleet.
Right.
So I think those are the two things you want to try to validate. Now, so I think if you started off talking about competition, so then I think it sounds like the question may be, hey, can the existing players move into the small medium business?
Yeah.
It's now, and I don't know if that's okay. So I think you're going to have to talk about that.
Right.
And I would say in those situations, when you're like, hey, how do I justify that a competitor is not going to do this? It could be, hey, we've just got this unique technology and we're custom built, and we just don't think the other companies are going to do it.
Yeah.
Or it could be a business model type of thing where you could say, hey, you know what, they're just like, so for instance, I would say Kijiji, right? Like when we launched Kijiji, the newspapers could have launched a classified site the next day.
Right.
They were known for it. They had people coming. But the fact is they couldn't launch a free classified site because that would cannibalize all their existing revenue. Now they could have if they were long, but they weren't going to, right? And so we were able to compete with them. So if there's something sort of like from business model structurally where, hey, they can't do it because we're so much cheaper, and if they lower the price, then they're going to cannibalize all their existing revenue or something like that.
Yeah. I understand. Yeah, makes sense. So in your experience with the validation, have you seen institutional investors investing in companies that have competitors or are not deeply patented, but have proven business models, so to speak?
So I think every single business has competitors. And I would actually say one of the things that I notice most consistent, and even if the competition is do nothing, right? Like even if nobody's, I don't know, you bring technology to, and you say, hey, there's no other person doing the technology in this industry. It's like, yeah, how are they living today? Well, they're living today on spreadsheets. Okay, your competition is spreadsheets.
Yeah.
But I would also say one of the things that I notice missing most often from startup pitches is they just look at the competition in terms of status. What does the competition look like today? And I always say to founders, okay, if you're successful, how is the competition going to respond? Because they're going to have much more resources. So it's not about who the competition is today. It's like sort of game theory, right? How are they going to react? And how are you going to make sure that they don't just wake up one day and say, oh, I don't like the fact that, Payal is taking market share. We're going to launch tomorrow and we're going to bring all our resources and our marketing might, and we're going to knock you out.
Yeah.
Love that answer. That's great.
Thank you.
Karen, you're next up.
Thank you. So my question is around investment, and maybe from a founder's lens too, because you come from both lenses. In terms of we're in an investment round, we have a lead investor. It's great. So is it normal? So we want to be strategic in the investors we bring on board. And I think it was more of a matter of, it's hard to get that lead investor. And then once you have a lead, I think the follow-on is becoming easier, right? To get more interest, right? So I guess what is the balance between being torn of someone wants to give you money, which is fantastic, but you also, it's not just about the money, it's more about what doors can you open? Like, do you have experience in our industry? Do you have something else you can bring to the table? And what's the balance between that? Because it's not like, you know, I'm torn between rejecting money because we need money, and then also the fact of, you know, I want to make sure the right people are investing because I also want more than money. I want doors opened in that. So where just to get your input on that,
Yeah,
what
so-
that
so-
balance is.
I would think about getting money. I don't like the value that they bring. It's a bit of a spectrum.
Yeah.
On the one end, it's bad. On the other end, it's good, and then you have the middle, which is neutral.
Mhm.
It's not like, for sure, stay away from the bad money. And I'm sort of like basically using very blunt terms, right? It's a more nuanced, right? But bad money, like people who are going to cause problems, you want to stay away from that.
How do you know they're going to cause problems though? Like, how do you know?
Reference check
Okay.
that they've other. There's not many bad investors out there, frankly. Not many, but you should reference check who they've other invested in. I mean, frankly, you see more bad behavior from late stage US investors who will do things like, and it becomes more of an issue at the later stage when when you as a founder no longer control the company, and they come in, within 2 months, they've decided they want to fire the CEO or, whatever. So it's anyway, so as long as you reference check them and you think, okay, they're not going to cause problems. Sometimes it's okay to get money that's in the middle, as long as you can think about, okay, how else am I going to get those things? So like you talk about, like, let's say getting customer references, getting all this. It could be that you get that value add, you could get an advisory board. Or maybe you don't even need an advisory board. Maybe you just have people, hey, can you introduce me to this person? Can you introduce me to this person? Right? And then you get that. And then, so it doesn't necessarily always need to be wedded together. Sometimes money is fine, and you take your money and start building your business, and then go and build an advisory board or a network of people who will help you do everything, all the other sort of value add that you were hoping to get from your investors.
Okay.
Is it possible too, Janet, that you could have a few individuals that aren't able to write as big a checks, but can bring more strategic to you, right? So fill your round with a few of those friendlies that can help you move forward. I think that's a common theme with women angel investors. They aren't able to write as big a check, but they can bring huge amount of value from a time and networking standpoint as well too. Yeah. Questions, folks? Oh, come on, one of the quiet ones. Sylvia.
Yeah, Sylvia.
I have a question. Hi. So I'm going to piggyback on what Karen was talking about. So we're working through a term sheet, lead investor, and same thing. They're US based, so it's a little bit further, still getting to know, still dating. Seems all right, but the hope was to have somebody, I'm in Toronto, just outside of Toronto, to have somebody a little bit more local with more closer relationship. So as you are introducing this potential second one, following the lead one, what are some of the best, I guess, practices and rules, and how to structure it so it all works well?
So can you clarify your question? So you have like a term sheet from the lead investor who's in the US.
Mm-hmm. And then there is a Canadian investor who we're still sort of, they're going to do a follow-up, they are interested, but it's pending sort of, the lead investor kind of how much, and we're raising, we are raising 1.5. They went in on a full 1.5, so it's actually above. So now we have a follow-up, which is amazing. But now it's figuring out sort of the deal structure for the follow-up investor.
Yeah, so I think you could talk to the investor, the lead investor, and say, okay, hey, let's just say they're putting in 1.5, and they won't say, hey, we want to put in 1.5 million, we're doing a $1.5 million round. Then you could do, and how much does this new investor want to put in?
Well, they asked me what would be, hey, these guys are going for 1.5. I'm like, no, I really want to work with you. And our initial was higher, but because we were talking to US, we're talking to Canada, we're like, okay, let's make it 1.5. But we do have a plan if we get more money, how we're going to accelerate our growth. And they were okay with that. So we were like, yeah, we can go up to 2.5.
Up to 2. Yeah,
Yeah.
so then you can go up to 2, say, okay, great. And first of all, congratulations. That's a great,
Mhm.
Thank you. It's
Not a
a
problem.
work in
Great situation.
progress. Thank
so
you.
yeah, you could go to the lead investor and say, hey, I'd like to bring these folks in. So how about we increase the size of the round to $2 million, and they'll bring in 1.5, and then you'll get 500,000. You may also want, depending upon where your valuation is, but you may also say, hey, with this, I'd like to increase the valuation a bit so that you can not get too diluted.
And what, and I'm going to ask for a number there, Janet. I mean, I understand, generally 20% to the first round of investors is okay. And
Yeah.
more than that, it starts to be a problem later on, right?
Yes.
Okay. Okay.
Okay. Yeah. So, and Julia, we've chatted. So,
Yeah.
Okay.
I don't remember all the details of you.
yeah, but 20% is, that was my
Yeah,
kind
okay.
of, that was the
Okay.
cap. So yeah, no,
Okay.
thank you.
Okay, good. Sophia and Rana.
Yeah, I just had a general question about women in this space as founders, and when we pitch to potential investors, and balancing like being authentic, but also being like confident, and like if you have any thoughts or advice that you would offer to women in particular, because I'm sure you've seen pitches and there might be something that you think like, oh, I wish women would do this thing that will help
I
them.
think generally, so I'll just make a general statement.
Yes, yeah.
What I have seen from a lot of women is women love to, and do it myself, under promise and over deliver. And so as a result, a lot of times when they will develop a pitch deck, they will put in their pitch deck in terms of their forecast, numbers that they feel very confident that they're going to hit. You are then competing, because investors can only write so many checks. You are competing with male founders who will go on the upside. And so an investor will look at your two businesses and say, oh, well, this guy over here, his business is going to be so much bigger. And this woman, no. So, I mean, I think you have to be authentic, but also be confident enough and, put your best foot forward and put realistic numbers, but don't put numbers that, oh, I need to beat them and like I'm going to go low. No, be realistic and think big and think aggressively and think positively and put that together and put that plan together.
I find the exercise that might help is you think worst case, you think best case, and then you start to figure out where you want to be on that line. I think if you go through that exercise, then you'll be able to push yourself a little bit further and be more assertive in your plans.
Yeah, that's a good one. Thanks.
Okay, no problem.
Rana, you there?
Yes, I'm here. That was actually a really great point. I'm going to change my numbers now. But my question, Janet, is I'm in hardware, and then I also have a bit of part of our technology, our hardware has AI capabilities. So not only are we able to sanitize cosmetic brushes and tools, but we're actually able to read the types of microbes on the tools. So you mentioned that certain investors aren't hardware focused, and they're absolutely, when do you see it tipping the other direction?
Well, I think like anything, you need to understand and Sylvia, I thought about this, but basically I'll just make a general statement. If an investor says we won't do this, or we want to put in 1.5 million or whatever, or we don't want to raise the valuation, make sure you understand why they're saying that. Okay, and again, I'll come back to this, but Sylvia, I was thinking about this, right? you, back to your case, if you're negotiating, if you don't already understand, did they say they want to put in 1.5 because they need 10%? Or did they say they want to put in 1.5 because that's their minimum check size? Or what is it, right? And how Granite goes to you is, I think if somebody says, hey, why don't you invest in hardware? So let's say you ask me, why don't I invest in hardware? Because these rules are never firm, right? It's like, at the end of the day, it's the partners can decide what they want to invest in. And I would say, you know, I don't invest in hardware for two main reasons. First of all, it's very difficult to pivot hardware. If your hardware doesn't work, or you decide to change the business a bit, if your hardware to change your hardware, that can be 6 to 12 months. It can often be very capital intensive because you've got to buy this hardware, right? You got to buy it, you got to finance it. So those are the two reasons. So what I would suggest you do is, if you can say, you know what, I know that you may not want to invest. If it's like, if you were pitching me and say, hey, Jan, why don't you invest in hardware? Then I say this, and then you could say, well, you know what, actually, I'll tell you why our business does not, you know, has avoided that. Like, our product is already in market, it's standard, it's not going to change. What we're iterating on and what we're developing is the software. And let me tell you why it's not capital intensive, because we get it paid up front or whatever, right? And then you can address those concerns.
Great.
But I think the key theme right on here is, if an investor says, no, I won't invest, like, really understand what their reasons are so that you can address the underlying concern that they have.
That's great advice.
Perfect, thank you.
And Ron, you know, your future revenue, which you've told me is mainly software, right? So you make your hardware is going to be your differentiator that you're building on to create a software solution, right?
Yes.
Yes.
It's an interesting play. Excellent. People have gone quiet on me. I haven't heard from who haven't I heard from? Sydney. Sydney, tell me.
I'm soaking it all up. We're a hardware only company, so we're a
Okay.
hardware only medical device.
Yeah.
So I'm just soaking it all up. But it's been fantastic advice so far. And my camera's off while I was eating, but I swear I can listen.
Okay. That's okay. I'm being mean is what I'm doing right now.
Yes.
I don't mind.
Yeah.
I can take it.
I know you can.
I mean, I'm just thinking about other general advice I would have. I mean, how many of you have raised a pre-seed round?
They're all starting. They're all in.
Friends and family.
So you're all starting to do your initial raise.
Yeah.
Awesome. Okay. I would also say the other piece of advice I would have in terms of raising money is, you've got to talk to a lot of people.
Mm-hmm.
As entrepreneurs, we are naturally optimistic people, or we wouldn't be doing what we're doing. Do not assume that anyone is going to invest until they sign the paper, and even then, until you get the check in the bank.
Yeah, that's good.
Right? Because I have seen, particularly in this environment, things fall through. And so one of the challenges that I have seen is, I've seen founders who are like, you know what? I think we're good. We've got 3 or 4 investors who are all really keen. And we're going to have decisions in the next few months, but we got 4 who are all in due diligence. I'm feeling really good about it. And my advice to you is, keep going, keep going. Do not count on those investors coming through. Because I have seen too many founders, they say that, and then all 4 fall through. And now they've just wasted 5 or 6 weeks believing that they're going to get one of those 4. Those 4, none of them come through. And then they're like, oh shoot, now I got to start again. And I shouldn't say waste time. You don't waste time, but I've just spent all this time has gone by. I now have less runway, and I got to start reaching out again. So I would just say, even though it's time consuming and you might rather be calling on customers or building your product or whatever, like, until it's closed, or at least until you have a signed term sheet, keep hustling.
Yeah, that's fair. I think Sylvia first. I saw Sylvia wave her hand, and then Payal.
Yeah, I wanted to ask, so how do you navigate that conversation? Because that is exactly what I'm thinking. And I'm like, until it's a signed deal, same as with a client, it's the same. Until I have a signature on a page and a check in my account, we're still working through sort of that transaction. So, but when, okay, I have a lead, negotiated a term sheet, what is the right way to approach other investors to be able to create a sense of urgency and yet, you know, be respectful of I don't know, the lead investor, I guess.
So I think, most times, if you get a signed term sheet, that investor will close. But you should ask, when you get a signed term, so first of all, don't count on anything until you got a signed term sheet and you both signed it. Once you have a signed term sheet, then you should ask the investor, or you could ask them beforehand, what percentage of your term sheets have you not gone through on? What types of things would prevent this transaction from going through? Now, I've had founders ask me that, and what I say is, in my 10 years, both like everything I've seen, the only one reason I said there's only one reason for me, there's only one reason why a term sheet isn't going to go through, and that's if the founders have a criminal record. I actually should add another one, because it just happened, where the two co-founders have just split up. And so I think we may pull that term sheet. But I mean, it's something like that. Like, for most investors, that's the level of type of thing.
Yeah.
I think, like, losing it, as what I say to the founders is, losing a key customer, economy going south, competition coming out with a product, none of those will make us not go through on a term sheet. We're getting into a 10-year relationship. Like, if you can't handle those little bumps, we shouldn't be, you know, like, but I know of at least one investor recently, and we were shocked. They pulled a term sheet after they had signed it and they claimed a reason that they knew from day one. It's the first time I've seen it from a Canadian investor. So, but I just ask them the question.
Okay.
I love Eva Lau's way of talking about the investor founder relationship is like a marriage. It's 10 years is a pretty good stint. You have to be prepared to spend. Payal and then Julia.
Yeah. Hi. So I wanted to know, from your perspective, what advice would you give to founders like us to strike in terms of striking a balance for, you know, growing your business while also raising the funds? So it's like one takes away from the other.
Yes. And I think that you need to do both. I mean, there's no easy way. There's no other way. You need to do both. They both are necessary to keep your business alive, unless you think you can bootstrap your business. I do think that you need to run a process when you're running a fundraise process. If you haven't been to the Liran, a guy named Liran, Liran, from Benchside, CEO of Benchside, has written some great articles. I actually led his seed round, and he's written some great articles on the fundraising process. I think it's important that you run a tight process, you know, and like, you have all your materials from day one, you have your data room, and you go 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 until you get a certain signed term sheet. And then, assuming that you think the investor is going to close, then you can, you know, you still got legal work to do, but then you can take off. So you need to do both. But I guess also another way of thinking is, at different times, you're going to have different areas of focus. And the important thing is, when you're fundraising, understand that you've got to fundraise and manage the business as a second priority. Then you get your fundraise done and you're back managing the business. And hopefully you have co-founders or others around you who can keep driving the business forward while your focus is on fundraising.
That's great. That's great. And Julia, and we're also going to try and do a pick quickly, but and I want to make sure I have time to say thank you to Janet before she disappears. So Julia, go ahead.
Hi, thank you. Thank you, Janet, for this really great, insightful information over the last hour. It's been very helpful. My question is about investors who maybe have taken a pass on this round, and then you re-engaging them maybe after 12 months. Let's talk a little bit about that and how that re-engagement should happen and that conversation.
So absolutely, you should re-engage them. What a lot of people do is, they will, like, I get a fair number of emails from people who, if it's pass, if I say pass And then it depends, right? So if I get emails regularly from companies that I've passed, but they are like, if I would pass on an investment, they'll say, hey, can we add you to our investor email list? And then every month I get an email from them. It's nice you can do that. You cannot, frankly, I wouldn't spend a whole lot of time on that. I'm not sure how much time some people say it's the most important thing you gotta do it, other people not. So you get conflicting advice on that. But I would just reach out to them and say, hey, and just, the other thing is make sure you remind people who you are and what your company does. Right?
Yeah.
Like, don't assume, like, right? So Julia, like you were, hi, so-and-so, I'm Julia, as you may recall, we met a year ago, my company is doing this, we were here, now we're here, would love to re-engage.
Yeah.
Like, I get emails from people who's like, hey, Janet, it's Joe. Can we talk again? And like, they have a Gmail address, and I'm like, I have no idea who this person is. So I was not very often, but just like, that sort of thing. People like that. Investors like to rehear.
Yeah. Wonderful. I'm going to let you go because I know you got lots of things, but Katie, if you could try a pick quickly, that would be great. And just and while I'll talk while we're doing it. But Janet, thank you so much.
Okay.
It is fantastic. You taking the time to do this, and I can tell already that we did a lot of learning today. So I appreciate it.
Well, thank you so much. A real honor to be here with everybody. I wish you all the best and hope to keep in touch with you.
Yeah.
Thank you.
Thanks so much.
Janet.
Bye.
Thank you.
Bye,
Bye.
everyone.
Thank you.
Thanks.
I'm looking at some folks and I'm like, oh, they have mastered the
Yeah, what?
They've mastered the like posing like beautifully while on
Yeah, that was good though. That's
That was fantastic.
Yeah.
It was really great.
yeah.
Oh,
Yeah,
I should
it's
stop recording.
easy.
Well, we're just complimenting, so.
Yeah, I was just I figured we could put something in the blog too.